We have other areas that are of note today. Financials, they're bouncing back yet again. A lot of these stocks are up today, not nearly as much as they were at the start of the trading day, but we do have some which are now positive on the week. By the way, Jamie Dimon, 1 o'clock Eastern, exclusive on this network on CNBC. It's coming up for an interview with Leslie Picker. You don't want to miss that. In the context of everything that's been going on, especially, we have ownership of JP Morgan on this desk. I don't know what he's going to come out and say, but what about these stocks like his?
Well, I think they got knocked down basically on the recession fears more than anything. Maybe there was also some fear that with the margin unwind on the yen carry, that there would be some balance sheet explosion or implosion somewhere. But I think more than anything, they came down on recession fears, which bring up concerns about credit losses, drying up of capital markets. And as we see those recession fears reasonably abate, it is equally reasonable to see these stocks start to perform well. And on the reversal of what I just said, that credit losses should not be that high, that the yield curve steepening will be better for net interest income, that capital markets, which has been showing some good signs of life. I mean, on the earnings calls a month ago, there was a lot of chatter about M&A picking up, that will continue. And I think that's absolutely right. I think these stocks should recover.
I mean, despite the panic attack carry of Monday morning, JP Morgan is up on the week by 1.25%. Goldman Sachs is up by 1.75%. Bank of America is up even in the face of Buffett with the string of selling that they've been doing. Citi's in the red on the week, but you've had a nice bounce back.
Yeah, I think with financials, partially it's the recession fears being alleviated, but also as people have been concerned about their exposure to the mega caps. You know, the mega caps are so big as a percent of the S&P that you just take out a few percent and you add it across the board to other names, and they can get a pretty significant bounce. JP Morgan's a big company, but you get the point.
You've been doing some trimming, though, in the space of Amex, of Blackstone, of S&P Global. Not, we're not talking big banks or money center banks but
financials.
The like, but financials.
Yeah.
Why?
Well, I think that they've had an enormous run. These are stocks, American Express up 24% a year to date, and that's about travel and consumer discretionary spending. We've had a lot of that, and it's reasonable to feel that if the economy, while growing, is not growing quite as fast, wages aren't going up as much, jobs aren't growing as much, these stocks have outperformed. Let's take a little off the table because we've had a great run, and it's just being prudent as portfolio managers.
You're more than double now the S&P in financials, probably the most significant change that you've made in the rebalance of late.
Yes. Insurance companies, financial services, insurance companies, 11%. Progressive, Travelers, higher on the week. Financial services, take a look at the exchanges. We all talk about elevated volatility, persistent volatility, 65 VIX on Monday morning, CBOE, CME, ICE, Virtu Financial, all higher on the week. These are the places that I think investors want to be. Do you want to buy some money center banks? Absolutely. JP Morgan, that's the place you want to be. Goldman Sachs and capital markets. You can even pick up some regional banks here if you don't think the gloom surrounding the recessionary environment is going to hamstring lending, which I don't believe it's going to. But I think the focus on financials, the resiliency and the outperformance cannot be dismissed. It's gone on for the entirety of 2024, and it's a sector that I think you want to have ownership.
Okay, Steve Weiss agrees. He joins us now because he bought more Goldman Sachs. Weiss, good to talk to you. Tell us about this move you made and why.
Yeah, thanks, Scott. So to me, it was a pretty simple move. Given how much the market is driven by algos and by ETFs, you often get dislocations when you're looking at companies on a bottoms-up basis. And I thought that Goldman was one of those. So while it's a big position for me and a core position, their earnings report was excellent. And everything that's driving the market lower is actually good for Goldman. So by that, I mean what's going to drive the market lower is the fact the economy is not as good as perhaps others perceived. I've been cautious on it, as you know. So that means a lowering of rates. That would further extend or increase the growth in the M&A cycle. That would also have to, increase the IPO or the issuance cycle. And then, I also like Goldman because they're not impacted. They don't have consumer businesses now. So I'm not worried about what's happening with the consumer as far as Goldman's concerned, would be with B of A to a larger extent, but not with Goldman. And then I want to be with the best risk manager out there. Again, that's Goldman. So if companies, and not the general companies we talk about, which have fortress balance sheets, but the others that are on the bubble, if the economy goes against this highly cyclically sensitive company, then you've got to then go out to the market and fund it through additional debt, distressed debt, high yield debt, whatever you want to call it. So everything lines up. So when things are really bad, there's a tendency to throw everything out. I just thought this was one to pick up. And by the way, just my view in the market is we're not out of the woods yet. I still think it's too early to start putting money in the market depending upon your time horizon, just broadly speaking, including tech.
We'll see you back on the desk soon, Weiss. Thanks for calling in with this latest Goldman move. One more reminder, too. Again, top of the hour, Jamie Dimon, exclusive with Leslie Picker, and you don't want to miss that.